Here is a fact most investors do not want to hear. 83% of retail investors underperformed the S&P 500 last year. Not because they chose bad companies, because they had no structured process for evaluation. They reacted to headlines. They followed price action. They acted on feeling, not data. In the next 7 minutes, I will show you the exact 5-factor system I use to rate any stock. Fast, consistently, and without emotion. It is called the signal score. Why a structured framework matters in 2026. The information environment has never been louder. In 2026, retail investors process an estimated 300 data signals per trading day. Earnings calls, macro reports, social sentiment spikes, analyst revisions. The volume is not the problem. The lack of a filter is. Consider what happened to Nvidia in early 2025. The stock dropped 18% in 3 weeks on AI spending concerns. The data, margins, order backlog, data center revenue, had not materially changed. That was noise. Investors with no framework sold. Investors with a framework asked one question: do the 5 fundamentals still hold? For most of them, the answer was yes. That is the entire purpose of the signal score. Not to predict price, to separate signal from noise consistently. Define the signal score. What it is, the signal score is a 5-factor analytical framework. Each factor is rated on a scale of 1 to 10. The total score is out of 50. The 5 factors are business quality, valuation, momentum, risk, and sentiment. No single factor determines the verdict. That is by design. A stock can score high on momentum and low on valuation. The total tells you the full picture. Scores above 35 generally indicate a strong data profile. Scores below 25 suggest multiple caution signals. The range in between requires deeper investigation. This is not a buy or sell indicator. It is a structured lens. The data still needs your judgment. The 5 factors in detail. Factor 1, business quality, 1 ticket 10. This factor answers one question. Is this a structurally good business? Look at 3 data points. Gross margin consistency over 5 years. Evidence of a moat. Pricing power, switching costs or network effects. And revenue trajectory across the last 3 to 4 quarters. Where to find it? SEC filings, company investor relations pages, macro trends for historical margins. Red flag, gross margin compression over 2 or more consecutive years with no structural explanation. Factor 2, valuation 1-10. Valuation answers, what are you paying relative to what you are getting? Use 3 metrics. Price to earnings versus the 5-year historical average. Free cash flow yield, FCF divided by market cap. And EV/EBITDA relative to sector peers. Where to find it? Macro Trends, FinViz, or any investor relations annual report. Red flag, PE more than 40% above the 5-year average with no step change in business performance. Factor 3, momentum, 1 to 10. Momentum is not about chasing price. It is about whether the underlying business is accelerating. Check 3 things. Revenue and EPS growth direction over the last 3 quarters. Whether the 50-day moving average is above the 200-day. And institutional ownership trends. Are large funds adding or reducing positions? Where to find it? Earnings releases, SEC 13F filings, FinViz technical view. Red flag. 2 consecutive quarters of revenue deceleration while price remains elevated. Factor 4, risk, 1 to 10. Risk scores are inverted. Higher score means lower risk. A cleaner balance sheet earns more points. Assess 3 areas. Leverage, debt to equity and interest coverage ratio. Concentration is more than 20% of revenue from one customer, region or product. And regulatory exposure, active investigations, antitrust scrutiny, or pending legislation. Where to find it? Balance sheet in 10K filings. Geographic revenue breakdown in the MD&A section, red flag. Debt to equity above 2.0 combined with rising interest rates and narrow interest coverage. Factor 5, sentiment, 1 to 10. Sentiment measures how the market is positioned, not how you should feel about the stock. Check analyst consensus, the ratio of buy, hold, and sell ratings, short interest as a percentage of float, and social or retail sentiment trend, not as a signal itself, but as a contrarian indicator. Where to find it? Seeking Alpha, FinViz, FINRA short interest data. Red flag. Short interest above 15% of float combined with deteriorating analyst consensus. That is a crowded trade in one direction. Signal score in action. Apple, AAPL. Here is how the framework applies to Apple as of mid-2026. This is a live example, not a recommendation, factor score, or 10 key evidence. Example, Apple, AAPL. Business quality, 10-45% plus gross margins. Services segment now 25% of total revenue. Durable ecosystem lock-in. Valuation 5, 10p/E, 27x versus 5yr AVG of 24x. Free cash flow yield, or 4.1%. Slight premium to intrinsic range. Momentum 7, 10 revenue, 3/4 acceleration. Institutional buying elevated. 50-day MA above 200-day. Risk 6, 10 China revenue is 18% of total. Regulatory pressure on App Store. Manageable balance sheet risk. Sentiment X, 10 analyst consensus. 38 buy, 9 hold, 2 sell. Short interest, 1%. Crowd slightly optimistic. Total signal score 3250. Cakes. Verdict. Solid business at a slight premium. Data warrants monitoring, not urgency, 32 out of 50. The data shows a high-quality business trading at a modest premium. Multiple factors are solid. Valuation is the primary area to watch. That is a conclusion based entirely on observable data, not sentiment, not narrative, not quarterly earnings call tone. What most retail investors get wrong. 3 patterns appear consistently among investors who underperform. Mistake 1. They use one factor and call it. Analysis. Most retail investors check the PE ratio and stop there. Valuation alone has almost no predictive power in isolation. A stock with a PE of 35 can be cheap relative to its growth rate. One factor is not a framework. Mistake 2, they conflate narrative with data, a compelling story about AI or semiconductors or weight loss drugs. That is not a data point, it is a theme. The signal score forces you to back every claim with a number. Historically, the gap between narrative and fundamentals is where losses are made. Mistake 3, they ignore risk. Until it is too late, risk is the most underweighted factor among retail investors. Leverage, concentration, and regulatory exposure rarely appear in social media analysis. They appear in 10K filings. The data is there. Most investors do not look. How to apply this starting today? The signal score is not complicated. It requires discipline, not expertise. Pick one stock you currently hold or are watching. Open its most recent 10K or earnings release. Rate each of the 5 factors on a scale of 1 to 10 using only the data in front of you. Do not start with a conclusion and search for evidence to support it. Start with the data and let the score tell you where you stand. That process, applied consistently, is what separates structured analysis from guessing. If you want to see the full signal score on NVIDIA, it drops Thursday. Subscribe and turn on notifications.